So how long can you fund a whole life insurance policy for that has a 1090 design? The answer is as long as you'd like. So what we're going to look at today is an example of someone who is 35 years old. He's interested in funding a total of $30,000 per year, but what he wants is as follows. Number one, he wants a 1090 setup. And if you're new to this and you don't know what a 1090 design is, it means that of his total payment of $30,000, he wants 10% or less if possible to go toward the base premium, and then the other 90% to go toward his paid up additions rider. I like to call this a cash dump in. The reason why he wants to do this is because the base premium does not show up in cash value in the first year. The insurance company overcharges me for the death benefit up front. So if we reduce that base premium, we reduce the costs and we reduce the upfront pain that a lot of people feel with whole life insurance. That's the whole purpose behind the 1090. And why it's 10% is when you look at the top mutual companies, a lot of times that's as low as they'll allow us to go. Some do let you go a little bit lower, but a lot of times it's right around 10%. So first, he wants a 1090 design. And then second, he'd like to see if he can pay $30K per year for 50 years. So let's take a look. What we're going to start with is a common objection. We're going to look at a policy that shows $30K per year going into a policy for 10 years. But then what we're going to do is take that exact same policy and show what it looks like if he decides to fund it for 20 years, 30 years, 40 years, and then also 50 years. And what you're going to see is this will be the exact same policy with the exact same setup on day one, where he doesn't have to pick up front if he's going to fund for 10 years, 50 years, or anywhere in between. He can pivot as he goes with respect to the number of years he pays into the policy and also the dollar amount. So let's start with 10 years, because a lot of times people hear that if they go with the 1090 setup, they can only pay into it for 10 years or less, or 1090s only work for something like that. So what we've got is a policy with one of your 4 major mutual companies. Here we go. So here's the funding of $30K per year for 10 consecutive years. Now, the first question I would ask if I'm you is, where is my money going? And you can see it on an illustration. So up top, we can see what is called our base premium. With Mass Mutual, they updated their limits earlier this year, where we can have a base premium lower than 10%. So here it looks really good. It's at about $2,400 per year. Then we have a term insurance rider that prevents a MEC from occurring. It shows $634. It's actually a little bit less than that. Some of those dollars are going toward PUAs. But then we've got a PUA rider here of $27,000 per year. And if you add those 3 up, it gives you a total of $30,000 per year. So here you see $30K per year going in. First year cash value, just about $28,000 right out of the gates. And it looks good in terms of the break-even point. He gets his money back between 3 and 4 years. But in this example, we stop after 10 years. So what this person wants to see is a policy set up like this, where it is cash rich right out of the gates, because that minimizes the number one objection to whole life insurance, which is the company takes a huge amount of my money in the beginning. When I reduce the base premium, I don't feel that as much. But I still want to be able to pay into it for a long period of time. Can I do that, Steve? That's the question. And the answer is yes. Here's the illustration we just looked at. Take note of the year 10 cash value. It's $359,323. This is the 10-year funding example where beginning year 11, your out-of-pocket is 0 indefinitely. Look at this illustration and start by looking at the year 10 cash value, $359,323. It's identical to the last illustration. The difference here is that we continue to pay into it for 20 years. Here's the same thing, but funding for 30 years, 40 years, This is the next page. And then also 50 years. All the exact same policy. Now I know this can be tough to go back and forth. So what we've got here is a nice side-by-side. So first, we see the example where we are paying into it for 10 consecutive years. You can take note of the first year cash value, and you can also take note of the break-even point. The break-even is the first year that our cash value exceeds the total amount we've paid into the policy, which is year 4 in this particular case. And then by year 10, you see that 359, 323. So next, we've got the exact same thing, but funding it for 20 years. So if you look at year 10, you'll find that the values are identical across the board. It's because it's the exact same policy. You don't have to decide which option you're picking up front. You're just deciding after you've started if you're going to keep funding it for 20 years or if you're going to stop after 10. You could stop after 2 years with this example if you wanted to. So we did 30, 40, and also 50. And when we look at it, you'll notice across the board, everything's identical through the 10th year. If we look at the year 20 example compared to the 30-year funding example, they're the same because I've paid the same dollar amount in up to that point. So this is just meant to display the fact that you can have a whole life insurance policy with a 1090 split, which means a minimum premium, a maximum PUA rider, set up with maximum flexibility and maximum cash value from start to finish without being limited in terms of how much you can pay into the policy. It really just has to do with the design of the policy upfront and also the company that you select. All insurance companies do have different rules. If I want to fund a policy with a 1090 split for a long time and I want to use one of the 4 major mutuals, I'm going to gravitate toward MassMutual because I know from a design standpoint and their specific rules, I can set a policy up like this. Now, if I like to have more flexibility with respect to just dumping PUAs and PUAs into a policy anytime I want, I know Guardian's very accommodating, but they're not always the best if I want to have a 1090 split and be able to fund a policy for a very, very long period of time. So to go back to the question, how long can you fund a 1090 whole life insurance policy for? The answer, as long as you'd like. It just depends on the company you choose and how that policy is initially set up. I hope you enjoyed this video. If you did, please let us know your thoughts below. And as always, I hope this helps.